everyone. My name is Lisa Rodriguez, Director of Sales here at NuView Trust Company. And I'll just give a minute here for everyone to get into the webinar. Today, we have the pleasure of hearing from Anthony DeLuca. So if you'll just bear with us here for a couple of moments as we let everybody in. Okay, we'll go ahead and get started. So today's webinar is about beating inflation by finding income in the self-storage world. And we do need to provide our disclaimer. Basically, we do not provide any investment advice, tax, or legal advice. We are a self-directed passive custodian for alternative investments. So self-directed IRA is basically a marketing term. It's not an actual IRA. And what I can do is go through some of the types of IRAs in just a moment. But just to let you know, it is a self-directed marketing term rather than an actual IRA. Here are some of the benefits of self-direction. So you get true diversification when you self-direct. You can invest into alternatives such as real estate or notes, private entities. And obviously you have your tax benefits as a result of that. And a lot of times people that self-direct, they self-direct into investments that they are already doing outside of an IRA. So definitely know a lot more about that particular investment option. Here are some of the different types of IRA plans that we offer here at NuView. We have the traditional IRA and the Roth IRA, and you can see some of the contribution maximums based on age there on that slide. Also employer plans that we offer. So the solo QRP is a self-employed, usually just one owner or an owner and a partner on that QRP. And then we have SEP IRAs and simple IRAs. So those are all employer plans. And then we do have specialty accounts like the education savings accounts and the health savings accounts. So again, those are the contribution maximums annually, and then age and information that you would need. So what can you invest in here with NuView? We offer different investment options, and we have specialized pods that actually help with the interaction of all of these investments. So we have private entities, real estate, crypto, and promissory notes. And you can kind of see on the slide, each of the different topics have the bullet points of the different options under real estate. For example, you have the foreclosures, tax liens, apartment, real estate options, condos, unimproved land, commercial property, including storage, right? So that's what we'll talk about today. And the next slide is going to introduce our speaker for the day, and his name is Anthony DeLuca. I'm going to read his bio here shortly for you. So he's a recognized expert in the field of wealth management and alternative investments. As a principal and wealth manager for Delta Capital Management, Anthony is integral to the money management process. He sits on the company's investment committee that oversees company investment direction for over $175 million of investor money. He's had a passion for real estate, specializes in the area of corporate finance and alternative real estate transactions for clients across a wide variety of industries. In recent years, he has worked to develop investment and financing alternatives using the broadest range of financing structures available to maximize yields and flexibility for his clients. He graduated summa cum laude, both a geoscience degree and geographical information system certificate at FAU, or Florida Atlantic University. And he played Division I college football for 3 years. So without further ado, I'll go ahead and introduce Anthony DeLuca.
Hey, thank you, Lisa. Thank you guys. Thank you for being on. I know if you're either eating lunch or after lunch, so I do appreciate it. I'm going to look to share my screen now. Okay, great. So I'll get started. I appreciate the introduction. Again, my name is Anthony DeLuca. I'm a financial advisor and a fiduciary here in Orlando, Florida. And the biggest thing that I want to harp on, let's see if I can get this PowerPoint rolling here. There we are. I'll start with the agenda real quick. I want to start with the economy. Again, looking at storage facilities and storage units, you want to make sure that you're getting the whole picture. I'm not going to do a whole dissertation on it, but there'll be a few slides about it. And I want to touch on how we're looking, especially fixed income sides. I'll talk about the self-storage industry itself, and then I'll sort of follow it up again with our brand and potentially what we offer, and then answer any questions beyond that. So again, just want to start. Anthony DeLuca here in Orlando. The biggest thing that I do is that I'm a fiduciary, work with on the private side with a lot of clients in a lot of individual accounts, IRAs, 401ks, estates. One of the bigger things I do with storage units itself is on the manager side there, I act as a conduit for individuals who are looking for something a little bit more unique, especially in a market like today. The stock and bond world can be quite volatile and a little bit of a head scratcher. So you want to have an alternative placement that can be a good fit. It's a good piece in any portfolio, and the right piece can make a big difference down the line. So I put this picture up on the economy as a joke a little bit, but certainly, some people might feel this in their portfolios. It's definitely been a little bit hairy, and we can look at the big problem child, and it's talked everywhere. It's in the news, in the newspapers, it's talked about. You see it in the gas prices. It's inflation, right? So this is the CPI, the Consumer Price Index. This is essentially taking in basket of goods, what it used to cost versus what it costs now. And inflation is our big impact. One thing that people try to do is look at the core CPI that disregards food and energy. And you might think, well, why would you get rid of food and energy? That's pretty vital and important. But the numbers can be manipulated just briefly. In 2008, a barrel of gas went up to $150. And once it was speculated afterwards, about $50 of that 150 was of speculation. So you look at CPI and core CPI, it can be a little, what's the word I want to use? A little scary to look at right now. So just want to touch on what inflation is, right? It's when there's too many dollars following not enough goods. So you're looking at the CPI here. We're at about 8.5%. We were at about 8.5% in April. We went down to 8.3% in May, and it was looking hopeful. And then we went back up to 8.5, 8.6%. And that is why the markets are reacting such. The reasons for this is, of course, we're still coming back from a COVID situation. I mean, you look at even today, China shut down for 2 months, and only just 2 weeks ago did they open back up, where we get a lot of our supplies. And again, with COVID happening, we did have a lot of supply chain issues, and we also had a lot of labor shortages. I know that the statistics were saying that of pre-pandemic job, we are 85% recovered, a little bit over 85%. So we are seeing that, we have wage growth because there's demand for workers. And again, the supplies chain is flowing back a little bit. We are starting to see some numbers. So again, the Purchasing Managers Index is an indicator we can look at. That's at about 56%. So anything above 50 is good. You're still seeing consumers buy. Then I know it was about 1.3% growth of buying in April, 0.9% growth of buying in May. So we are still seeing a little bit of inflation taking its route. We still do think it's going to come back in the long term, but in the short term, it shows. It really shows that's the problem child. The top index there is the S&P. The left side there, that big drop, that's the COVID drop. And you can see that in comparison for the S&P now on the right side. It's not as steep, but it's certainly starting to hit that mark, and it's actually over a long term. I mean, we're officially in a bear market. That's just flat out the truth. The S&P is down today it's about 21%. The NASDAQ, which follows tech, so tech and growth were huge during COVID, right? But as interest rates rose, tech companies can't get loans with interest rates that are going to meet their margins. So they're getting hammered. NASDAQ's down about 31, 32%. What I have down there is the aggregate bond. That's the Barclays bond aggregate. And I wanted to show this because it's tough for bondholders as well. So when the Federal Reserve Board, they control overnight rates between banks, what banks loan to each other and what the banks loan from the Federal Reserve Board. So as you hear this talking, right? Interest rates are rising. So as they raise their interest rates, what you notice is that the bond market, fixed income bonds are saying, hey, we don't want to get out of this. Inflation's too high. We're going to sell our bonds. We're going to move into short-term bonds. So bondholders are also seeing a big hit. We haven't seen something like this since the 80s. So there's a potential silver lining when it comes to the rising interest rates. As you look to the left side, this is the 10-year note. So in May of 2020, you couldn't get any yield. I mean, you were essentially at 0.5%, if that, before you even consider inflation. So we are starting to see with the rising interest rates, some sort of return. So again, the 10-year notes at about 3.2 to 3.3%. Your corporate bonds obviously are going to do a little bit better because they're not considered the most safe. They're the next safest, not the safest, right? So they're running about 4% to 4.4%. And your mortgage-backed securities as well. They run in parallel. Your fixed income investors look at these two. So they actually run more in tandem than the Federal Reserve Board rates do. So that's actually what you want to notice. But the big picture that I want to bring this all together is that your yields in still consideration are still annualized negative 4% because inflation in CPI is at 8 to 8.5%. And when we pull this out in a bigger picture, this is what I'm referring to, is that if you look over in the 1980s on the left side here, what you're noticing that this is the car age. This is when people were lining up for gas, right? So you were getting inflationary numbers in the 14, 15%, but you were still able to get bonds, corporate bonds themselves at 15, 16%. So in essence, you were still able to return 1%. What we're seeing now when you pull back to present day is that, okay, maybe we can get 3%, 4%, maybe even a good corporate bond at 5%, which we're finding in some portfolios for our clients. But we're still looking at inflationary numbers at 8%. And that's really important when we're looking at how can we really find growth. So tailing that into the self-storage industry, that's why we're really excited about the industry. I think there's a lot to offer. And going into the details, you're going to see that I noted in the beginning of the beginning slides how it could potentially be an inflation resistant. So you think of as advisors, when we would walk into our office during COVID, March, April of 2020, and we were sitting there watching the screens, and we would see it drop 5, 6%, 7%. The bell would ring and the stock market would stop. And we were just wondering, man, like, when do we hit the bottom? And we're watching this and we're just seeing portfolios and we're answering questions and calls and we're staying confident and true in our approach, but it can certainly be nerve wracking. I mean, this is people's estates, their livelihood, and it's their money. So it's important to think about. But you look at how storage did during that time with COVID, their average monthly rent was $108 per month. So per square foot basis, average cost was $1.16. That changed from 2020 to now was 21.4%. The demand for storage in 2021 even went higher. So the idea is that people who go into storage facilities, they go into it more of a need. It's a need market. So actually, when inflation hits and recession hits and 1 in a million, right, a pandemic hits, your demand for storage goes up because your supply goes down. And people are just going to take their stuff out because the reason they're in storage is because they need it. They need it. So the supply chain actually, in the long run, helps storage. And that's something really interesting to consider. And when you look at the numbers too, apartments are one of the more oversaturated real estates you can invest in. I mean, you drive anywhere and you certainly see it. I want to note that because the returns aren't necessarily bad, but very, very oversaturated. You compare that to the S&P, this is going to be about over a 20-year span here. It does about 7.5%. 17.43% is what the average self-storage REIT did from 1994 to 2017. There's growth to be had because, and I'm going to get into the details of it, it's simplicity, it's net OI, it's profit margins, and because it follows something very, very, very important, which is the lifestyle of humans. So according to the Investopedia, 50% of new business ventures fail in the first 5 years. Self-storage facilities fail rate is 8%. If you look at the past 10 years for more real estate side of it, so more multifamily, more commercial, more apartments, that area, that fail rate's about 53 to 65%. So self-storage sits there at just 8%. Again, 85 million Americans now rent a storage space, storage facility. And a facility can make a profit between 60 and 70%. The average is about 90% because of demand. So you start to think about these numbers and you wonder, why is there such success in self-storage? And it's because self-storage follows lifestyle route. And what I mean by that is people are constantly changing careers. They're getting married, they're having kids, they're unfortunately getting a divorce, they're upgrading their home, they're downgrading their home. Kids are always going to college. one thing you noted during COVID was the such spike in self-storage is because people started working from home. They had home offices. They created home gyms. I personally created a home gym. And now that you're coming out of this COVID era, hopefully we're on the tailwind of it, you're still seeing this changing demographic of how people want to live their life. And it's true, more people work from home now. There's less gym memberships in 2022 than there was in 2020. So all these play an important role that self-storage follows the route of humans. One thing that's also really crucial to think about with self-storage is its simplicity. You only need a few qualified employees to run it. It's not a huge conglomeration that takes, you need a chef here, you need a manager here, you need all these different aspects. It's very simple. New technology is actually running where you have one core location that is digitally monitoring all these different facilities, and that allows for no to minimal employees. And point 3 is interesting too, because it's actually true that many renters, they do procrastinate if they don't need it, or if they don't even want it, or if the rent is being raised too much, that they actually won't move their stuff out because of just natural procrastination. You put it in there because you put your stuff into the storage facility because you didn't have space for it. So moving it out isn't going to be so easy either. So it's also something to know. And again, unlike residential real estate ventures, well-built steel facilities demands very little upkeep and maintenance. I want to just point the stat out to look at the annual revenue for self-storage industries. 2021 in the market was interesting. It was unique in the fact that 2020, we had this huge drop, but we had this huge roar back. 2020 was a little stagnant in the later part of the year, but yet annual revenue was still $38 billion for self-storage facilities. So that's something I wanted to know. I like showing this slide because this slide shows very important trends. It shows before, during, and after COVID. Your top shows that actually construction trends, they were blossoming during a bull market in a roaring economy. COVID hit, we saw this pullback. Construction trends were down at the top, but if you look at the middle, at the vacancy rents, they're down over 460 basis points. So as I noted in the beginning of the slides, your construction trends are down, but your vacancy rents are down too, because demand is still up. And looking at the bottom to tie it all together, 2020 and 2021, growth rates skyrocketed. 2022 and moving forward, we're going to see a little bit of slowdown. That's natural. We had an unusually spike because of an unusual situation of COVID. So we're going to find a more steady bring back, about that 4% range in 2022. But very important concepts to know moving forward. So I want to tie it all together of today, the demographic of how things are moving. So for our brand, Your Storage brand, we target mainly in the Orlando area and Southeast area. We're branching we have places in Georgia and South Carolina. We're starting to work out towards Texas. There's a spot in Ohio we're also moving, but demographics are very, very important. The top 10 places that were moved to in 2021 were all in Florida, Texas, and Arizona, for many reasons, of course. But again, it's all about finding your demographics to target the right areas. I know Orlando's growth for rent change was, for climate control rooms, was 8%, and then for non-climate controlled, it was 6%. So that's just in Orlando. I know Charleston was even higher. It was like 10%, 8% respectively. But moving from where we were, where we are now into the future, I would say this is probably one of the most important slides to think about, because you speak of something, you think, okay, well, if we're speaking of it now, we already missed the button. We already missed the hot topic, right? Well, that's not necessarily the case. It actually turns out that the changing Gen X and the Gen Zs and the millennials, they actually love their stuff more than the older generation. And that just goes back to people moving into smaller areas or moving into more urban areas, and people just being collectors. I mean, that's just the nature of the business. And it actually shows that the top graph shows that Gen Z has a bigger incidence penetration, 28%, and millennials are the next highest versus their population versus any other demographic. And the bottom chart is even better to comparison, is that total businesses are actually on the decline, but self-storage renter and businesses themselves are on the incline. So our penetration, as you saw in 2005, is 10%. In 2020, it's almost at 12%. So very important stats to look at, that there's fewer businesses, but there's actually more self-storage. That goes again with the growing of population and growing of human desire to want more stuff, that American dream really becomes a cultivation in what is shown here. So kind of tailing that back graph of America into this is that where you pick your industry is important. So where we target mostly in your storage brand is the South, and we're starting to tail out west. So again, we have up to date, I believe, 26 different construction projects that are completely finished, fully 90% occupancy, thriving, or in development. A lot of it is in Orlando. We have 6 or 7 different facilities in Orlando, touching in Panama, Jacksonville, I know Augusta, Georgia, Aiken, South Carolina. So where you touch your points is important as well. So again, regions dictate where self-storage can be successful. So again, one of the bigger questions is how do you drive this income? Where does the success of the self-storage come from? And showing these numbers, Public Storage, obviously huge REIT, nearly a 1.75 billion in 2020. Their forecasted NOI between 9.4 and 11.9% in 2021. Extra Space Storage, same success, NOI nearly 770 million, predicted NOI growth from 13.5 to 15.5%. Biggest thing here is profit margins for Class A self-storage is between 30 and 40%. It's because of its efficiency. It's because you can change your rent monthly to your customers month to month, and you can work with inflation. That's very, very, very important to be flexible in that nature. Customers have to get insurance on their products, and that allows for, if you raise rent $2-3, no one's going to take their stuff out of self-storage. This accumulated over an 80,000-90,000 square foot facility. Then you compound that over thousands and thousands of facilities that you have underneath. Your margins are able to work with potential cost orders of maybe increased cost to build and consideration of the market today. So kind of wanted to round the last corner here a little bit and touch on who we are. I know I've kind of given a little bit of information on us. That's our information below too, if you do have any interest. We are mainly out of Orlando. We certainly have facilities in other areas, but we certainly would offer any due diligence to see any of the facilities, meet any of the bigger players that I'll touch on as well. But we're a brand in a growing brand, and we're excited about the route. You know, Class A self-storage really has a place in different economies, in different environments, and we're starting to do our due diligence to make big headways. I just wanted to show quickly just 2 gentlemen, Richie Webster and Bill Johnston. Bill Johnston's the CFO, Richie Webster is the CEO. So what is very unique and cool about our brand per se is that Richie Webster is a gentleman who owns a company called Rapid Building Solutions. Rapid Building Solutions is a very successful company that builds Class A self-storage facilities, sports facilities, airline hangars, things of that nature. That company itself builds for all the big names, all the big self-storage names, still builds today. They're building 70 to 80 a year, and they were really churning and burning. So Richie Webster took a step back and thought, hey, why not us? Why can't we also own facilities? So that was the birth of this situation. So you have a gentleman who is a savant in building and construction, and he's also the CEO of the company itself. Bill Johnston's a brilliant man, very smart guy, his master's from Harvard, has his CPA. He's been working with many different private equity groups in building and construction and making sure everything runs smooth. He's probably been with over $1.5 billion of assets and movement. So really smart brains, and really excited about the team itself. Where we find our niche and where we find our success point is that this is a fractionalized industry. So what does that mean? You have your public storage and your extra storage space. You have your big guys, but then you have the main portion, the majority of the other half, the 74%, is just small, unsophisticated operators. And you see that when you drive along. You're always just driving along and you see a rugged, rundown self-storage facility. That's the majority of self-storage facilities. So for us, there's a niche that we can be that in between and grow into the big. And we're starting to see that, and we're really having success. So it allows us to kind of build a more sophisticated team, a more technology advanced team, and allow us to kind of be with the time. And that's really important for us. So just kind of showing there a little bit moving forward. I wanted to touch on this as well. I know looking at case studies is important to kind of bring it all together. This is the facility we have in Aiken, South Carolina. We do our due diligence, and we have a team that really goes out and makes sure that we're finding the right spot. We're looking at just this example alone, 3-mile radius. The average household income is $94,000. That's great demographic numbers to put something. And these are the positions we always put ourselves in to make sure that the facility does well. And again, we sought out a facility in, I believe it was Ohio, and the demographics weren't necessarily there for the success. The gentleman knew better though. Put it there. We're starting to have a lot of growth in it. I would say most of our facilities, like I would say in Orlando, are at least at 60%. The St. Cloud, Kissimmee are well above 75 into their 80%. We have one in Panama City as well. That's over 90% operation. We have a new one in Apopka that's about 10 months ahead of schedule. So it's all about location, location, location. So you look at these demographics again, average household income, and you start putting it into a map. This is key. This is called path of progress. So you see the star there right above that Old Navy symbol. You want to put your self-storage facilities in a place of best success. So we're moving with path of progress of production, putting it in the great spot. And all those little dots and trees to the northwest there, those are all houses. And to the northeast there, all houses. It's about putting place in right position for success. So that's how we're always looking at our demographics to find the best location. Wanted to show one more, see if I can get the pop up. Kissimmee, Florida. Kissimmee, Florida is booming right now. That's where Disney is. You have, Disney is kind of blossoming out there. The growth rate of the human population that we noted there was very valuable. And that's exactly what we put a facility there. Again, path of progress. It shows where we're located, where it's going, houses near it. You have the Lowe's, the Best Buys, fitness center. It's all there. It's all together. So that's how we look and how we manage our facilities in forward progress. And the last thing I did want to show again is self-storage is unique, that you can take facilities that were a past and make it into something that's a future. Panama City, we actually took what's an old Kmart. So we were able to take this Kmart and we were able to convert it into a self-storage facility. So that's a little bit of a unique on us as well, and I wanted to add. So I wanted to make this quick brief. I wanted to make sure that I hit all the main points and that you guys had all information on it. I would certainly welcome answering any questions afterwards. Again, we're very open to conversations, meetings, due diligence, meeting the players and talking a little bit more about who we are and what we can offer. So with that, I am done with my presentation, Lisa. I'll let you kind of flow back in here.
Hi, thank you so much, Anthony. That was a wealth of information, and it's greatly appreciated. Let me go ahead and see if we have any questions here. If you do have questions, please make sure you put them in the chat or the Q&A. I do have one here specific to whether or not you have a fund available, and
Yes.
just to keep it on the educational front. Where can they reach you specifically for the details of the fund or any additional information that you can share besides just the stuff on that slide, or is that the best opportunity for them to reach you?
Yeah, that's the best opportunity virtually. Certainly that email works. That's my cell phone. I'm a very personal guy. So if you want to call me or shoot a text, I would certainly welcome that. Again, I am personally located in Maitland, Florida, and our group is mainly originated in Orlando. So certainly would meet in person, grab lunch, shake hand, and talk more. We'll keep it educational. We did have a past fund that was very successful and closed. We have a current fund that is open now. It is a 506c fund. And we're also talking about potentially unraveling a Reg A fund. So we're certainly welcome discussing those points. We use it a lot with some of our clients on the private side, like I said, as a really good piece, an alternative. And it's valuable. Listen, there's value in anything in the investment world in the right amount. You can find great stocks, you can find great bonds, you can find great alternatives. It's about finding the right group, meshing together for a good portfolio in the long run.
Okay, thank you. So with that, we'll go ahead and get to the next slide. If you are ready to start self-directing, or if you would like to add an account to NuView or another account to NuView, you can reach us at iraspecialists@NuViewTrust.com. And then if you'd like to stay up to date with us on our social media and any events that we're having in the future here, you can go ahead and scan that QR code, or you can, follow us on Facebook or LinkedIn, et cetera. So have a wonderful day. And thank you so much for your time and joining us today.